At the time of the South Sea Bubble, Great Britain was under the reign of King George I, who ascended the throne in 1714 following the death of Queen Anne. This period was defined by political tensions between the Whigs and Tories, the two dominant political parties. The Whigs favored a more centralized government and commercial expansion, while the Tories were more conservative and supported the monarchy and traditional social structures. The political atmosphere was also influenced by the ongoing struggles for power between Parliament and the monarchy, leading to a growing sense of parliamentary democracy. Simultaneously, Britain was involved in the War of the Spanish Succession, 1701 to 1714, which had considerable economic implications. This conflict pitted several European powers against each other, resulting in high military expenditures that strained the British economy. Following the war, the Treaty of Utrecht, 1713, brought relative peace, but the nation faced the challenge of managing its national debt, which had surged due to war financing. The early 18th century was a period of significant economic transition. Britain was beginning to emerge as a global trading power, aided by the expansion of its colonial empire. The South Sea Company, established in 1711, was emblematic of this growth, aiming to trade in the lucrative South American markets. However, the broader economy was still grappling with the after-effects of war, including inflation and financial instability. Trade and commerce were increasingly important to the British economy, and new financial instruments, such as stocks and shares, began to take root. The concept of speculative investment emerged, driven by a growing middle class eager to engage in trade and commerce. This shift towards speculation and investment was coupled with a burgeoning interest in finance, leading to the rise of investment firms and stock exchanges. The social structure of early 18th century Britain was rigidly hierarchical, with a clear divide between the aristocrats and the growing merchant class, plus the working poor. The Industrial Revolution was still on the horizon, and most people lived in agrarian societies, relying on farming for their livelihoods. However, urbanization began to take hold, particularly in cities like London, where economic opportunities attracted rural inhabitants. Daily life for the common people was often fraught with challenges. Many faced poverty and struggled to meet basic needs. Social norms were deeply influenced by class distinctions, and the roles of men and women were clearly defined, with men typically engaged in trade or labor, while women were often relegated to domestic responsibilities. However, the rise of the merchant class began to alter some traditional dynamics, granting certain women limited opportunities in business and trade. Culturally, the early 1700s were a time of enlightenment and intellectual progress. The Age of Enlightenment was characterized by a surge in scientific inquiry, philosophy, and literature, leading to a shift in how society viewed knowledge and authority. Figures such as Isaac Newton and John Locke influenced contemporary thought, emphasizing reason and empirical evidence. Technological advancements were also beginning to emerge, though the full impact of the Industrial Revolution was still to come. Innovations in agriculture, such as crop rotation and selective breeding, improved food production and supported population growth, while the early stages of mechanization began to reshape industry. The general mood of the early 18th century was one of cautious optimism interspersed with anxiety. On one hand, the period was marked by the promise of economic opportunity fueled by burgeoning trade and speculation. On the other hand, the political uncertainties and lingering effects of war created a sense of instability. As individuals sought to improve their fortunes, the allure of financial speculation grew, reflecting a broader societal shift toward risk-taking behavior. In conclusion, the South Sea Bubble emerged within a dynamic historical context characterized by political tension, economic transformation, and social change. This era set the stage for one of the most infamous financial events in history, reflecting the complexities of human ambition and the precarious nature of economic systems. The South Sea Bubble was a significant financial event in early 18th century Britain that encapsulated the risks and excesses of speculative investment during a time of economic transformation. This financial episode involved the South Sea Company, which was granted a monopoly on trade with South America and sought to capitalize on the lucrative prospects of trade, leading to widespread speculation and ultimately a catastrophic collapse. Founded in 1711, the South Sea Company was established to exploit trade opportunities in the South Seas, particularly in the Spanish territories of South America. The company was initially intended to consolidate and manage British national debt, particularly the debt incurred during the War of the Spanish Succession. In exchange for managing this debt, the South Sea Company was granted exclusive trading rights in the South American region, primarily focused on the lucrative slave trade and commodities like sugar and tobacco. The company's financial model involves converting government debt into shares, allowing investors to buy stock in the company. This arrangement promised high returns, which made the shares attractive to a growing class of investors eager to profit from the expanding global economy. The South Sea Company started selling shares to the public in 1711, generating considerable interest. By 1719, the company's shares had soared dramatically from 100 to over 1,000 euros, as investors became enamored with the idea of potential profits from South American trade. As shares became increasingly valuable, the South Sea Company engaged in aggressive marketing to entice more investors. The promise of vast riches from South America fueled speculation, and investors from all classes, merchants, aristocrats, and even the common populace, poured their savings into the stock. Newspapers published glowing accounts of the company's prospects, further inflating interest in share prices. The companies employed several tactics to sustain share prices. This included issuing more shares to create the illusion of profitability and allowing investors to exchange government debt for South Sea shares at inflated values. Moreover, the company's directors engaged in insider trading, manipulating stock prices for personal gain. By 1720, the company's initial hype began to falter. The promised trade routes to South America did not materialize, and the reality of the company's operations was far less lucrative than anticipated. As news of poor trading results spread, panic set in among investors. In September 1720, the bubble burst. Share prices plummeted from their peak, leading to widespread financial ruin. Many investors lost their entire life savings, and public confidence in financial markets eroded. The South Sea Company's stock crashed to below 100 euros by December 1720, leading to an economic crisis. Several key factors motivated the South Sea bubble. The lure of high returns on investment was a primary motivator. The early 18th century saw a burgeoning middle class interested in speculative investment as a means to wealth. The promise of vast profits from South American trade created a sense of urgency and competition among investors. The British government sought to manage its debt through the South Sea Company. This created a system where the company's fortunes were intertwined with national financial stability. The government's involvement lent credibility to the company, enticing more investors. The culture of speculation and investment was gaining momentum in London during this period. The rise of stock exchanges and the proliferation of investment opportunities made it easier for individuals to buy and sell shares, leading to a frenzy of trading activity. The directors of the South Sea Company were driven by profit motives and engaged in manipulative practices to inflate stock prices. Their personal gains were tied to the company's share prices, incentivizing them to mislead investors about the company's prospects. The collapse of the South Sea bubble prompted immediate and significant reactions from various stakeholders. The immediate aftermath saw widespread devastation among investors. Many were left bankrupt, leading to public outrage against the company's directors and the government. Individuals from all social classes suffered financial ruin, leading to a loss of confidence in speculative investments. In response to the crisis, the British government initiated investigations into the practices of the South Sea Company. The crisis raised questions about the regulation of financial markets and prompted calls for reform. The government took steps to stabilize the economy and restore confidence in financial institutions. The public sentiment shifted from excitement and optimism to anger and distrust. The event served as a cautionary tale about the dangers of speculative investment, leading to a more cautious approach to finance in the years following the bubble's burst. In summary, the South Sea bubble was a complex financial episode characterized by a mix of ambition, speculation, and manipulation. It unfolded through a series of dramatic events driven by the motivations of investors and company directors alike. Ultimately, the collapse revealed vulnerabilities in the financial system and served as a turning point in how speculative investments were viewed and regulated in Britain. Two influential figures played pivotal roles in the South Sea bubble: John Blunt and Robert Harley. Their backgrounds, motivations, and actions significantly shaped the trajectory of the infamous financial episode. John Blunt was born around 1670 in Yorkshire, England. He came from a relatively modest background. His father was a merchant, and Blunt initially followed a career in finance and insurance. Blunt began his professional life as a clerk at a local merchant's office, where he gained invaluable experience in financial transactions and business practices. His ambitions led him to London, where he quickly established himself in the financial community. Blunt was known for his charisma, persuasive abilities, and vision. He was an ambitious individual driven by a desire for wealth and recognition. His talent for financial innovation and his willingness to take risks characterized his approach to business, making him a central figure in the speculative frenzy of the early 18th century. Blunt's motivations were rooted in a combination of ambition and opportunity. The post-war economic landscape presented a chance for him to leverage his financial acumen in an emerging investment climate. The establishment of the South Sea Company provided him with a platform to transform his ideas into reality, enabling him to profit handsomely while also enhancing his social standing. Founder and promoter of the South Sea Company, Blunt was instrumental in the formation of the South Sea Company in 1711. He developed the financial structure that allowed the company to convert government debt into shares, making the venture appealing to potential investors. Aggressive marketing and speculation. Blunt engaged in aggressive marketing strategies to promote the company's prospects, creating an aura of excitement around the potential for enormous profits from South American trade. His campaigns stoked investor enthusiasm and fueled the speculative bubble. Manipulative tactics. As managing director, Blunt was accused of manipulating share prices and engaging in insider trading to benefit personally from the rising stock values. His actions played a crucial role in inflating the bubble to unsustainable heights. Blunt's innovative strategies and persuasive tactics significantly shaped the South Sea bubble. By positioning the company as a lucrative investment opportunity, he attracted a wide array of investors, from aristocrats to common people, ultimately contributing to the massive speculation that characterized the bubble. His decisions not only facilitated the initial rise of the South Sea Company, but also set the stage for the eventual crash when the reality of the company's operations failed to meet inflated expectations. Robert Harley was born on December 5, 1661, into an influential Whig family. He was educated at Oxford and gained early political experience in the House of Commons. Harley's political career spanned several roles, including serving as the Speaker of the House of Commons and later as Chancellor of the Exchequer. His political acumen and connections in the financial sector positioned him as a significant figure in the early 18th century political landscape. Harley was well known for his intelligence, shrewdness, and political savvy. He had a reputation for being a skilled negotiator and strategist, traits that helped him navigate the complex political environment of his time. His ambitions drove him to seek power and influence both in politics and finance, reflecting a blend of ideology and personal gain. Harley's involvement in the South Sea bubble was motivated by a combination of political necessity and financial opportunity. As Chancellor of the Exchequer, he was deeply concerned about managing Britain's national debt, which had ballooned during the War of the Spanish Succession. His association with the South Sea Company was partly driven by a desire to stabilize the nation's finances while also positioning himself favorably within the political sphere. Facilitation of government debt management. Harley played a crucial role in linking the South Sea Company to the management of national debt. His support allowed the company to convert government securities into shares, making it a key player in the British financial system. Legislative support. He championed legislation that favored the South Sea Company, granting it monopoly trading rights and facilitating its growth. His backing provided the company with the credibility and support necessary to attract investors. Political maneuvering. Harley's political influence helped protect the South Sea Company during its rise, allowing it to operate with relative freedom and encouraging speculative investments. Harley's involvement in the South Sea bubble uniquely shaped the event by intertwining political objectives with financial speculation. His actions not only facilitated the initial success of the South Sea Company, but also highlighted the risks of blending political and financial interests. As the bubble collapsed, Harley's reputation suffered and he faced criticism for his role in promoting a venture that ultimately led to widespread financial ruin. The South Sea bubble instigated a significant transformation in investment practices. Investors became more cautious and discerning, leading to a decline in speculative behavior. The event underscored the need for thorough due diligence and understanding of financial instruments before investing. The bubble served as a catalyst for the development of regulatory frameworks in financial markets. Over the subsequent decades, Britain saw the establishment of more formalized financial institutions and regulations, paving the way for modern banking practices and the eventual creation of the London Stock Exchange in 1801. The aftermath of the South Sea bubble prompted a reevaluation of risk assessment in investment. It encouraged the rise of a more educated and cautious class of investors, leading to a focus on the fundamentals of companies rather than mere speculation. This shift laid the groundwork for more sophisticated financial analysis and investment strategies. The bubble also had a lasting impact on literature and culture, influencing public perceptions of greed and speculation. Writers such as Jonathan Swift and Daniel Defoe commented on the financial excesses of the time, reflecting a cultural shift towards skepticism regarding wealth accumulation and the moral implications of speculative investing. The South Sea Bubble serves as a cautionary tale in financial history, highlighting the dangers of speculative investments and the importance of transparency and due diligence in financial markets. It illustrated how easily enthusiasm can morph into irrational exuberance, leading to disastrous outcomes. The events of the South Sea Bubble have been referenced in discussions of later financial crises, including the Great Crash of 1929 and the 2008 financial crisis. It serves as a historical precedent for the potential volatility of financial markets driven by speculation and herd behavior. The bubble contributed to the evolution of economic theory, particularly in understanding market behavior and the psychology of investors. Economists began to explore concepts like bubbles, market cycles, and the role of information asymmetry in financial markets. The fallout from the bubble influenced British politics with calls for greater government intervention in financial markets. This sentiment played a role in shaping the political landscape and the relationship between the government and the economy in the years that followed. In conclusion, the South Sea Bubble had immediate effects that devastated individuals and created a climate of distrust in financial markets, leading to regulatory reforms and economic instability. Long-term consequences included shifts in investment practices, the foundation for modern financial regulation, and cultural reflections on greed and speculation. The legacy of the South Sea Bubble is a reminder of the fragility of financial markets and the importance of prudent investment strategies, influencing both economic thought and public policy for centuries to come.